Hey, what's up? Today, I wanted to share what is a sustainable APR and income that you can generate from concentrated liquidity pools without losing a lot of your initial capital. If you guys are new here, my name is Richard. I'm a yield farmer and investor. I was able to replace my full-time income with crypto and yield farming. If you want to take a deeper dive on my portfolio, I do keep a portfolio update playlist here that goes over my positions, but I don't make money all the time, right? Some months might go down, some months might go up. But so far, my track record has been pretty good. And we'll talk about balancing risk and reward a little bit, balancing APR and capital gains and capital losses, a few different strategies that people try to use to try to get more APR and kind of like what is the pros and cons behind that. And I'll also explain why I try to prioritize net profit over APR and give you my best estimate of the current APR. But I'm just tired of people losing money from chasing the range, from squeezing the range too tight to get a really high APR when in reality it's not very sustainable, right? So be sure to stick around to the end of the video so that you don't lose a lot of money in the process. So let's dive right in. And like always, this is not financial advice. Please do your own research before making any investment decisions. But really, when it comes to investing and yield farming, most of the time, 90% of our investments are going to fall on this risk chart, right? The higher reward that you aim for, the higher the risk. Like, let's say you're aiming for like 100% to 150% APR or more, then you're taking a bunch more risks, right? And when you take more risks, the chance of losing money becomes much higher. And this is potential reward, right? Because you're taking more risks, a lot of the rewards that you earn would actually be lost from the risks that you take. And this is especially true for stuff like, for example, meme coins that could give you like 100% APR or higher, but then you're also losing a lot of your initial investment as well if those meme coins don't do well, right? And sometimes when the market is really risk on, it does make sense to take more risk because the reward is much higher and your win rate is much higher. But most of the time, if you are chasing too high of an APR, you're going to be taking too much risk in your portfolio, and you could actually end up losing a lot of money over time. And again, if you go for a very safe strategy, for example, a full range LP on blue chip assets, you might be earning only like 5 to 10% APR, right? But then your risk is much lower. And anywhere in between, if you're using concentrated liquidity pools, it falls between like the low risk and the high risk, right? Depending on how wide you go. And I've just made this chart here, but basically I call this the yield farmer dilemma. Do we go with a tight range with really high APR, or should we go with a wide range that has more capital gains and less capital losses? It's always going to be a balancing act. If you have been yield farming for a while, you know exactly what I'm talking about, right? The tighter the range, the higher the APR, but at the same time, you're going to be missing out on more pumps. And then if the market pulls back really hard, you're going to be sitting in a lot of capital losses if you don't set a stop loss. So there's always a pros and cons with each strategy. But for most investors, if you don't want to spend that much time like managing your positions, looking at different charts, in my opinion, wide ranges would outperform 90% of the time, right? Sometimes when the market moves sideways, which sometimes it does in crypto, but in reality, it doesn't do that very often, right? If we look at a chart like Solana, you can see the price goes up pretty aggressively. It goes down, grinds sideways for a little bit, maybe 1 to 2 months, goes back up again. It's just very, very volatile. And if you're squeezing the range to be really tight, like let's say a $20 wide range, you're going to be out of range all the time, right? And then you're going to lose a lot of money if the market goes down really hard. And I'll explain that in a little bit more detail later. But basically, if you're not spending that much time managing your positions, if you don't know exactly what you're doing, switching from a tight range to a wide range strategy would actually decrease your risk by quite a lot and would allow you to have more capital gains and less capital losses, right? But it's always a trade-off. You can't really have like the maximum of both. If you're trying to aim for like 100 to 150% APR, you will for sure have less capital gains. and then also more capital losses, right? So it's up to you which strategy you decide to pick. But I like my ranges pretty wide, sometimes even full range, because I will have much more capital gains and much less capital losses when the market reverses to the downside. And sometimes people will try to balance the two, right? But it's pretty hard. For example, if you're running a tight range strategy, and then you also add a spot holding. So let's say you are yield farming ETH to USDC with a tight range, and maybe you hold a bunch of ETH on the side, right? Or maybe you're using a leverage strategy where you're lending out your ETH, borrowing some USDC, and then yield farming this ETH to USDC pair, right? Of course, you could combine these two strategies, but then this APR is really high. But then on the other spot bag, your APR is going to be low, right? So when you actually combine the two, you're going to get a more average APR. So let's say you're earning like 60% APR on this side, maybe with like 50% of your capital, right? And then let's not talk about leverage. And let's say you're earning a net 3% staking rewards from your ETH. Then your net APR is like 63% divided by 2 because it's half and half, right? Let's say you allocate half to this, half to that. Then your net APR is like 31.5%. So the net APR on your portfolio is going to be much lower if you combine these two numbers. And one thing I really don't like on YouTube is sometimes like a lot of people are very clickbaity. They're trying to show you that you can earn a ton of APR because that gets you more views, right? But the reality is you're not going to be earning like 60% APR on your entire portfolio, especially on blue chip assets like ETH to USDC. You're going to be earning much less than that if you combine your overall portfolio, right? And again, the more risk you take, the higher APR you can get, right? Of course, you could put your entire portfolio in a tight range LP to gain a higher APR, but then you're taking on much more risk because again, you're going to have much more capital losses if the prices do go down because you're setting a more concentrated range. When the prices move around, the conversion rate is very aggressive, right? For example, if I'm yield farming Solana from 200 to 240 as a range, if the price moves to the upside to like $300, I'm going to be selling my Solana around that range because the conversion rate is very aggressive, right? And it works to the flip side as well. If Solana dumps all the way to $100, I will have a lot of unrealized capital losses because I'm essentially buying Solana with whatever USDC I have left in this tight range at the conversion rate between the $200 to $240 range. So if you guys are seeing like really high APR from blue chip assets, typically it's not very sustainable and it could lead you to large losses later on. And I've tracked a bunch of different like yield farming portfolios. I've analyzed like over 100 different wallets. And I can tell you that people that really try to squeeze the range for the max APR, a lot of times when the big moves happen in the market, they're going to miss out on a ton of the upside while they're also taking on a lot of risk to the downside. So it's very risky in my opinion. I just want to share that because you got to have a more accurate view on the risk that you're taking. And you guys should be doing your own research as well. Track a few different wallets and see, if the tight range LPs actually make money, right? And to actually prove my point here and make it really simple, we could go on Beefy. Beefy is like an automated yield farming tool. I just want to prove to you that the range chasing strategy and the tight range strategy does not work at all. So let's say we go to this Uniswap pool, right? I've already pulled this up here. Uniswap on base, the APR is pretty decent on that pool. And if I look at the APY chart, you can see the average APY is around like 60 something percent. So that's including the compounding. Beefy automatically compounds the pool for you. So you don't have to worry about it, right? It sounds really good. You're earning an average of 60% per year. And sometimes the APR even spikes up to like over 100 something percent, right? It sounds really great. Now, what I really want to show you is that over a 1 year period, you can see their strategy, right? They basically track the range here with about like $1,000 wide range on both sides. When the price go up, they rebalance up. And then when the price go down, they rebalance down here. And then they go up, it rebalance up, and so on and so forth, right? So it's a range tracking strategy, a range chasing strategy. The downside with this is you're locking in a ton of impermanent loss. What's happening is as you move up, if you rebalance up, you're buying more ETH at a more expensive price, right? And then when the price moves down sharply, you're essentially selling your ETH at a very cheap price. And then you're repeating the whole process because as we know, crypto goes up, crypto goes down. You're going to repeat the whole process. And if your APR does not outpace the impermanent loss you're locking in, which it often doesn't, especially if the volume dries up, then you're going to lose a ton of money in the process. And to compare this is very simple. You can see the current price right now is around 43.49, right? And 1 year ago, when this pool was yield farming, Ethereum was worth only 2,365. So roughly a $2,000 gain, almost a 2x, right? 100% gain. But if we go to the price, this shows you the LP value, including all of the compounding already. You can see when it got started, it's like 764 billion on September 11th, right? And then right now it's sitting at 797. So it actually was not that much different from like the original price. So instead of doing the strategy, you might as well just be buying ETH and then just staking your ETH because this strategy doesn't even give you cash flow anyways, right? It's compounding your cash flow. You hear it all the time. It's like, okay, compounding is really powerful, but then it doesn't even matter in this case because you're locking in too much impermanent loss. And you can make like comparison with different pools as well. This is the Aerodrome pool on Beefy. Currently, there's still like 600,000 something dollars that's parked in here, right? So people that park their money in here, they absolutely do not know this. There's just too much like misinformation in DeFi and people just don't know any better, right? You can see that the price again is 23.65 when we first start out. But then right now it's 4,000 something dollars. And we could see the effect of range chasing here. Absolutely brutal. When we first started, 769 billion. And then right now it's at like 478 billion, right? So you're actually losing a ton of money because of impermanent loss and range chasing. And you can see the APY and the APR doesn't even matter because you're losing a ton of money in the process, right? That's the main point that I'm making here. Your APR actually does not matter if you're suffering too much capital losses. And then you're also missing out on a lot of capital gains. So which metric should you actually basically optimize around? I will tell you personally that I do not optimize around APR at all. Sometimes I will try to get a higher APR, but there's a max limit of the range that I would go to actually keep it very safe before I start to suffer too much capital losses, right? And remember guys, the APR that you're earning is actually analyzed, right? So it doesn't matter if it shows you like 100% APR on like the different platforms that you're tracking, but you're only in range for like 1 month or less, right? A lot of times people that are getting like 100% APR on blue chip pools like Solana to USDC or Ethereum to USDC, most of the time they're not going to be in range for more than a month. And sometimes you will get lucky where the market just moves sideways, but you can see how often does that happen, right? It moves sideways a little bit here, but then it moves up pretty aggressively, sideways a little bit, moves down aggressively, go up, move sideways, and then go down aggressively, right? And sometimes the downward move just goes down really hard without a lot of sideways movement. So your tight range strategy is going to be underperforming by quite a huge margin in this scenario. And in my opinion, it's much harder to predict when the prices would move sideways compared to, okay, where the prices are going to bounce, right? One is the favorable risk and reward. For example, right now, Ethereum is much more expensive than like a couple months ago. So if you got in a little bit early and you want to realize some profit, then it makes sense, right? And on the monthly chart, it does look like, Ethereum is testing its all-time high, potentially breaking out here in the next couple of months. We can't really tell the future, even on the price movement, but it's even harder to tell, okay, like this is the zone where the price is going to move sideways. So don't fall for the high APR, guys. It's not sustainable, even if you're doing a bunch of more like complex and advanced strategies. You're buying put options, you're buying call options. stuff like that, you're sacrificing a big portion of your APR anyway if you're doing that. So then I personally don't like to go through all that trouble and then just focus on my efforts on wider range strategy. And what I want to also emphasize is that if you guys live in the US and you want to pay taxes, this is something that you need to consider as well. I've talked to a lot of accountants in the past. This is my best understanding of it. And if I'm wrong, you guys can leave it in the comment and we can discuss this. But basically, your liquidity pools would earn fees, right? And then the fees that you harvest, you have to actually pay like income tax, and then you get the rest, right? And then the rest you could reinvest or spend it, use it however you want. And then on the other side, we have the LP, right? The value is going up and down. And if it goes up, you pay cap gains tax. And this is if you close your position in dollar profit, right? Sometimes you will be in crypto profit. For example, you accumulated more Ethereum than what you started out with. You don't pay capital gains in that case. But if it's in a dollar profit, you do owe some capital gains tax. But the nice thing about capital gains tax is that if you suffer some capital losses as well, you can write this off, right? So you could reduce the capital gains tax by quite a lot. But from my understanding, you cannot like reduce this income tax. So if you're suffering a lot of capital losses while you're chasing the fees, you still owe this big portion of income tax, right? Let's say you're in the like 20% tax bracket, just to keep things simple. You started off with $100 and then maybe you earn like $60 because you had like 60% APR, right? But because you were running like the range chasing strategy, maybe your LP value would drop all the way to, let's say, $60 as well. But because you're paying 20% tax on that, you only end up with $48, right? When you add that together, maybe you get a profit of $108. So the actual profit that you get to keep would be much lower and sometimes even negative, and you still owe a bunch of taxes. Like in the case of the beefy aerodrome pool here, the pool absolutely got destroyed and it hasn't started to recover, right? The APY here, you can see right now, the APY is pretty low compared to like last year, which makes this strategy even worse. The only way that the tight range strategy is going to do well is when the prices move sideways and then you're also getting a lot of volume in the process, or the movement upward is just not that aggressive, right? And we don't see that often at all in crypto. A lot of times for these volatile pairs, you're going to have big aggressive moves. So I hope that makes sense. It's a little bit more complex and kind of what a lot of people don't want to talk about. I personally do have a coaching program and I'm also releasing my online course soon. It's teaching you how to yield farm, how to do it safely. It would be very tempting for me to basically promise you like 100 to 150% APR, right? I know exactly how to do that. I know how to pick like the best pools, how to squeeze my range for the APR, but it's just very high risk. And chances are this is just not sustainable over the long term. And the way a lot of people do it is they chase the range upwards to sustain a high APR. Let's say you started out here with a tight range, and let's say you're using a lending and borrowing strategy. So maybe you're lending out your Ethereum, borrowing USDC to yield farm a tight range, right? Of course, you could earn much more APR. You could use that APR to pay back your loan or to accumulate more ETH. As the price move up, it works well, right? Your LP value is kind of slowly going up all the time. You're earning a lot of fees in the process. Maybe you missed out on capital gains because of the pump, but that's not a big deal until a big sharp movement down happens. Because if a big move down happens, let's say you're chasing the range up here, you believe the market is going to trend up, but then you suffer a huge drawdown, you're actually fully into ETH when this pops out of range, right? And then you're also losing a couple months of no yield if you don't want to rebalance down. So then the APR is not as high as what you expected in the first place. And again, if you do rebalance down like the beefy pools, you're going to be absolutely shredded and destroyed. If the price moves upward, your LP value is not going to recover because you're actually locking in a ton of losses down here, right? So don't expect that high of an APR from the blue chip pools. Typically, if you're willing to take more risk, you could try to get around like 25 to 75% APR. This is an estimate that I like to give my clients, and it's much more sustainable. In the bear market, maybe the APR is going to be lower, But if we're seeing a ton of on-chain volume, like what we saw last year, then we could be shooting up higher as well, right? Maybe 80% to 100% APR in some pools, even with wide ranges. And again, this is such a big range is because the strategy that you run could be different, right? For example, if you are yield farming higher risk pairs, you could be going for like the higher APR. And let me show you one of my current wallets here. You can see sometimes we're going to be doing really well. There's capital gains, there's positive Ethereum divergence loss, which means that Athena is trading above my entry in this case. I'm earning a ton of fees in the process. Like right now, it's 32% APR on average. So really good here. You could argue that this pair is higher risk than Ethereum to USDC because we're now relying on the performance of Athena, right? And then there's also higher risk and lower cap stuff, like for example, Pixel that I'm bullish on. This is a full range LP and it's pulling me like a 42 something percent APR, right? Of course, this is higher risk. So I do have a slight positive divergence loss as well. And I'm expecting this token to do well in the altcoin season. That's why I'm yield farming this. And then there's also meme coins like MOG and ETH, right? I'm earning a 69% APR with a pretty wide range here. You can see it's quite wide. If I zoom out, it's capturing these whole price movement, right? I like to zoom out on the weekly chart and the tightest I would go is basically like the bottom and the top of the range, right? But you can see it's trading slightly below my entry right now, but I've earned enough fees to cover this divergence loss, right? So over a long period of time, as long as the token don't bleed out too hard, I could still be profitable even with the negative impermanent loss. And Syrup and ETH as well. Again, this range is quite wide. I'm trying to have more capital gains. And like I said, right, it's always a balance between like capital gains and the APR that you're generating. And of course, I could squeeze the range and then use a spot bag of Syrup if I expect Syrup to outpace Ethereum by a lot to offset the upside risk, right? But again, if you're balancing with the spot bag, the overall APR of your entire portfolio is going to drop anyway. There is no such thing as like, high APR, high reward, and no risk and no trade-off in crypto, right? There's always like a trade-off that you have to make. But you can see overall my track record is still pretty good. And hopefully in the altcoin season, I could close a lot of these pools in a profit like Pixel and Athena here in the next coming months. So by taking more risk, I'm able to generate higher than 25% APR. And if you guys are yield farming with like wider range blue chip LPs, your APR could be more towards like the 25% range, right? So this is a more realistic APR that I like to give. And again, with altcoins, we are taking much more risk than like the blue chip assets. And instead of focusing on too much APR, what I would encourage a lot of people to think about is we want to kind of think about like, okay, profit is much more important than APR, right? We see it with the beefy pools. Just because you're earning like 200% APR doesn't mean that you're actually profitable, right? I could easily show you guys, okay, I'm doing this range to get like a really, really high APR. But then over time, if that pool is unprofitable, then whatever APR I earn actually doesn't matter. You could be earning 200, 300%, 1000% APR. If you don't make a net profit, then you're basically wasting your time, right? So we always want to think about, okay, how do we secure more net profit rather than the APR? I would rather make a 50% plus net profit and only a 10% APR in the process, right? But what a lot of people do is they're making 100% APR, but their net profit is like maybe minus 15%. So the APR is not even covering the net profit, right? So the profit is the most important metric that we have to optimize around. The APR actually does not matter if you're taking too much risk, squeezing the range too much, especially on blue chip pairs. It's very tempting to be squeezing the range to get like a really high APR number, but that could put you at a huge risk of loss and you're going to be missing out on a ton of pumps as well, right? And even if you guys use a leverage strategy, using a wide range is much safer, even though your APR might be significantly less, but over time, the likelihood of you closing out your positions in a net profit is much, much higher. So I hope that was helpful, guys. I never try to bait you with the APR simply because I know that, that metric actually does not matter that much if you're giving back a lot of your gains. If you want to learn more about yield farming, how to do it safely, then be sure to check out the other videos on my channel. I put a lot of effort and thought behind this so that you can actually level up your skills, become a better yield farmer. Thank you once again for watching. I'll catch you next time.